Welcome back to my 10 favorite people. Hope you're doing well. I'm incredibly excited for today's video because we know Bitcoin usually follows the GLI. However, there has been a major divergence recently. And there has only been one other time this cycle where we've seen this type of divergence. And in retrospect, it ended up marking a very important momentum shift. Now, this indicator has served us very well this entire cycle because Bitcoin follows it very closely 90% of the time. But there are some brief periods where Bitcoin completely ignores it and does its own thing, which in itself is a signal. As you can see here, the last major divergence was when Bitcoin was grinding higher in late 2023, while the GLI kept going down after breaking out of a 7-month consolidation. At the time, everybody was expecting Bitcoin to break down because things were not looking good and the SEC was going after Coinbase and Binance, but instead, Bitcoin ended up having a major break to the upside that many people did not want to believe and were convinced it was a bull trap because there were so many bearish narratives at the time. And during that exact week, I published a video called Bitcoin Will Shock Everyone, where I explained that this type of strong breakout can't be ignored after that much consolidation, and it's very dangerous to assume that it's going to be a bull trap due to bearish narratives. Now, in retrospect, we note that underlying strength was coming from smart money accumulating aggressively in anticipation of the BlackRock spot ETF launch and the success it was likely going to have. But interestingly enough, today we find ourselves in the exact opposite scenario where Bitcoin had been consolidating for 7 months and everybody, including myself, was expecting a break to the upside due to all the bullish narratives and the bullish price structure. But instead of getting that breakout to the upside, Bitcoin ended up getting a clear range breakdown even as the GLI was grinding higher, showing a major divergence and a clear sign of weakness, which was the exact inverse of what we saw in late 2023. This is why I find technical analysis to be so valuable, because it gives us a chance to check our bias and have an invalidation, because bearish assets don't have strong range breakouts to the upside and bullish assets don't have strong range breakdowns to the downside. And in my opinion, it's much better to trust the breakout than to assume that it's going to be a trap because bearish narratives tell you so. And it's also much better to trust range breakdowns until the market reclaims that range breakdown level and prove that it is in fact a trap. I know it's very popular on YouTube and X to blame any price action we don't like on manipulation instead of just admitting that we could have been missing something and were perhaps wrong, but blaming everything on manipulation and being stubborn is a great way to be bullish all the way down during a bear market, and it's a great way to be bearish all the way up in a bull market. But now that price action has warned us that there could be something the bulls are missing, let's talk about what's likely causing this divergence and major weakness from Bitcoin. I believe the recent weakness for Bitcoin is not being driven by the 4-year cycle, it's being driven by the major hawkish pivot the Fed made recently. And in case you don't believe me, let me remind you that Bitcoin topped the exact week the US government shutdown started, and that pause in spending resulted in a refill of the TGA, which greatly tightened liquidity. But even more importantly, the lower high that resulted in the massive sell-off and the range breakdown happened right when Powell came out in the October FOMC meeting and gave a very hawkish press conference. We know Bitcoin is very sensitive to liquidity, and it's pricing in the fact that the current projection of only 325 basis point rate cuts over the next 12 months is not enough to stop the economy and markets from taking quite a bit of pain. And this pushing back of rate cut expectations is also putting upward pressure on the US dollar, which tightens liquidity globally because the US dollar is the global reserve currency and most debts are denominated in dollars. So a strong dollar makes those debts harder to pay back, and a weak dollar makes dollar denominated debts easier to pay back. And now I know what you're thinking. Yeah, the Fed being hawkish is not good for risk assets, and rates being higher for longer is not good for the economy, but it's not a problem because Trump is going to appoint his own Fed chair next year, and they're going to be super dovish and solve all those problems. And it seems as though everybody on YouTube and X has cracked the code and figured out that risk assets can't go down next year, which is resulting in major optimism from retail investors thinking that the new Fed chair is going to solve all these problems. But the awkward issue with that thesis and the elephant in the room here is that while mainstream media and retail investors are convinced that rates are going to be coming way lower next year, the institutional capital with billions of dollars in volume on the CME Fed futures is saying there's only going to be 2 rate cuts under the new Fed chair, as of right now. Now, these probabilities can and will change. This is just the market's current view based on all current data, and we will be receiving some clarity tomorrow at the press conference from Powell and the publishing of the economic projections from the Fed. But I do believe it's very dangerous to assume that just because there's going to be a new Fed chair next year, they're going to be able to convince the rest of the committee to vote alongside them. And that seems to be the consensus view among mainstream media, everybody on YouTube and X, as well as the majority of retail investors as of right now. And that brings me to another awkward reality, an elephant in the room that I see discussed all over YouTube and X, and that's that now that QT has ended, QE is going to happen immediately, it's going to happen aggressively, and it's going to pump the markets. But what it completely ignores is that the huge impulses of QE in the past happen after a crisis and after risk assets have crashed. The Fed also usually does QE once rates are already at zero. Now, it doesn't have to be the same this time around, but with only 3 projected rate cuts next year, I have a hard time seeing major QE happening in early 2026. And I think the current Fed rate cut expectations are telling us that. And that brings me to the final prevailing narrative that I see all over YouTube and X, and that's that the Republicans have to run the economy hot next year to make sure they win the midterm elections. So expect rate cuts, expect spending, expect QE, because they can't afford to lose the midterms. But in my opinion, quote unquote, running the economy hot into the midterms and reigniting inflation is the best way to get run over in the elections, because we know inflation is elevated, whether you look at PCE or core PCE. We know that the number one issue among voters right now is inflation. They don't care about the stock market, and they definitely don't care about our bags pumping. So even with a new Fed chair, how is the Fed going to justify aggressive rate cuts and QE with inflation at near 3%, GDP near 4% in terms of the Atlanta Fed real GDP forecast? It's still well above zero. And we also have employment weakening, yes, but still well below where recessions usually start, and still historically low. Continuing jobless claims are still relatively flat. Initial jobless claims, which is a great proxy for layoffs, actually had a huge spike to the downside recently, and even if that was a one-off, it's still well below where recessions usually start. And the main thing we've seen so far is a slowdown in hiring, but we haven't seen anywhere near the amount of layoffs or the amount of increase in the unemployment rate necessary to justify the Fed ignoring how elevated inflation is, because that is a very detrimental impact on everyone. So I believe our long-term trend of the global liquidity index rising will remain intact, but there will likely be some drops, so we'll have to risk manage along the way, and most investors don't seem prepared for those outcomes. So how am I preparing for this, and what changes am I making to my portfolio? I did take some small profits on Bitcoin, Ethereum, and Solana to build up my cash position back to where I want it to be. During this relief rally, I want to manage my risk to the best of my ability, which means buying a little bit on dips and selling during rallies so I can try to maintain some cash to take advantage of better buying opportunities in early 2026. And as always, if you'd like to learn more about my portfolio system or mental models I use to navigate this market, or common mistakes I see so many investors making, you can check out the Crypto Enjoyers program and community in the video description. For now, the S&P 500 continues to look strong and looks like it wants to make new all-time highs, which is exactly what we want to see for this Bitcoin relief rally to really have some legs and for Bitcoin to head higher. Gold continues to consolidate sideways, which should give risk assets some room to run in the short term. And Bitcoin is working on reclaiming its range low, and if it's able to do that successfully, we'll target the range mid and then the range high for this relief rally. I'm also monitoring the scenario where Bitcoin rallies into the FOMC meeting, triggering a lot of longs to pile into the market before having an aggressive sell-off before the Fed was more hawkish than expected, and then getting a strong recovery after that point. I would love to load up Bitcoin in the low 70,000s if given the opportunity. 91K is definitely the pivotal level to watch going into this week's close, which is why Monday's free weekly report was called Struggling at Resistance. Close above it and we have a bullish reclaim on our hands, get rejected and close below it, and we might have to test lower prices before we see a stronger relief rally. It's nice to see that buyers stepped in and Bitcoin got this bounce as soon as it entered our cheap region. As I've said many times on this channel, I want to have a profit-taking mindset when Bitcoin is expensive, and I want to have an accumulation mindset when Bitcoin is in the cheap region. Hopefully we get more opportunities to load up in that region in early 2026. The similarities between recent price action and 2022 continue to be mind-blowing. In 2022, we saw a false breakout, range breakdown, break below the 50-week, and then a bounce near the 100-week moving average. This time around, false breakout, range breakdown, break below the 50-week, and what do you know? A bounce near the 100-week moving average, and we have now established our range low. Now we just need to see where Bitcoin establishes its range high, and we can see if we can get some type of strong reclaim to give us some reason to flip bullish, or if it just ends up being a rejection and the 50-week moving average gets front run because so many investors are waiting for it to get tested. History is definitely rhyming, but it doesn't mean it's going to repeat the exact same way, so we have to be open-minded for plot twists. But as we have been saying for weeks now, this relief rally makes a ton of sense after the insane capitulation we saw a few weeks ago. Bitcoin realized losses by short-term holders hit $3 billion on chain that day, showing that investors were capitulating significantly. And even long-term holders, this is investors that held over 6 months, had 2.7 billion in unrealized losses that day. We also saw Google searches for Bitcoin bear market hit an all-time record, more than we ever saw in the last bear market in 2022, which is exactly what you would expect during a capitulation event at a local bottom. And it looked likely due to the Bitcoin daily chart death cross, which tends to mark local bottoms. So at the very least, we were expecting a bounce into a local high before rolling over, or maybe even proving itself and reclaiming that 200-day moving average. But the base case has to be a rejection until proven otherwise. So far, this relief rally continues to play out as expected, whether we are in a bear market, which is still my base case, or this is one big bear trap, which is possible, but isn't the base case right now. The relief rally happens in both scenarios. The real test is whether or not we're able to reclaim major levels. If we get rejected there, even more confirmation of bear market. If there's a reclaim, then we can start talking about bear traps and optimism. And there's always a bullish narrative that shows up at the tail end of a relief rally, catching investors wrong-footed, so I'll be keeping a very close eye on that. In 2022, that bullish narrative was Terra Luna announcing they were going to be moving a big chunk of their reserves into Bitcoin and buying $10 billion worth of BTC. Do Kwon, the founder of Luna, went on Pomp's podcast, and everybody was excited and bought in anticipation of Luna buying, but it was pretty ironic because the Luna's collapse ended up sparking the next leg down. And just to be clear, I don't believe in the Bitcoin 4-year cycle, and it's not the reason why I expect a bear market. I do expect this 4-year cycle pattern to break eventually. I care about price action and data. I was happy to ignore the 4-year cycle when price action was bullish and we were in an uptrend, and I've become a bit more cautious and concerned once we broke price structure and the data started looking a bit more concerning. For example, we can take a look at the Crypto Quant Bull Score Index, which includes a bunch of data points, and it just flashed a 0 on the most recent capitulation, just like it did in early 2022. And this metric has never flashed a false signal where it has shown 0 outside of a bear market. We can also take a look at market sentiment with the Fear and Greed Index spending extended periods of time in the fear region, which is something you only see in bear markets. We've also seen a divergence between sentiment and price, where price was making higher highs, but sentiment has been making lower lows and has not been able to reach the extreme greed and euphoria that we experienced after the election in December of 2024. There also doesn't seem to be a ton of interest in buying Bitcoin right now, according to the ETFs, even with it having a 30% off Black Friday flash sale. Same thing with corporate treasuries. It's pretty much been crickets compared to what we saw in late 2024 and in early 2025. Strategy is still trying their best, buying hundreds of millions of dollars of Bitcoin just about every week, but compared to the buys we saw earlier, this has been very insignificant compared to what we saw in late 2024 and early 2025, when the NAV premium gave Strategy so much more room to issue shares and buy Bitcoin. But the good news is that we are seeing that relief rally for Strategy near the 200-week moving average and previous consolidation, the exact same place we saw the relief rally in 2022. And maybe that'll give Strategy some more capital to buy more Bitcoin. So we'll see what happens. As of right now, December is slightly green, up 3%, which is a great relief after the November and October we experienced. As for Ethereum, it continues to look strong here with the false breakdown we talked about in the last video. We're almost near our first target at the range mid. Second target would be range high, and then we're going to reassess from there. ETF inflows remain pretty quiet, but we did get interesting news this week that BlackRock filed for a staked Ethereum ETF ETF, and it'll be interesting to see what kind of demand that generates because as of right now, ETF buyers are giving up the staking yield. Ethereum treasuries have been pretty quiet aside from Bitmine, which continues to buy. They bought another 199 million in Ethereum this week, and they're clearly the strategy of Ethereum treasuries, which means because of their brand, they're going to have access to the most capital, and they're going to be the ones that are able to buy during these times, while the others trade at a discount. Ethereum's upgrade also went live this week, and although I don't expect this to impact price greatly in the short term, it is great for the long-term user experience by making transactions faster and cheaper. And interestingly enough, we've been watching Ethereum outpace Bitcoin during this relief rally, with Ethereum Bitcoin slowly grinding higher, but I am keeping an eye on what happened last cycle where Ethereum had a consolidation, broke out, got rejected at the major pivot. This time around, consolidation, breakout, rejected at the major pivot, come down and retest the 50-week, bounce to the 20-week, come down to the 50-week, bounce to the 20-week. But last cycle, there was one final capitulation before new highs, so I'm keeping an eye on that scenario in case it happens again. As for altcoins, still really not much happening according to the altcoin season index, still sitting in the mid 30s. However, the Russell 2000 continues to show strength and is very close to breaking out, which could be a strong tailwind for altcoins. Solana continues to hold its range low. Target 1 would be range mid, target 2 would be range high. ETF inflows have gone pretty quiet, but Solana Bitcoin continues to hold its lows and maintain structure. So we'll keep an eye on how high this relief rally goes for Bitcoin, Ethereum, and Solana and try to stay prepared for multiple outcomes. But as we look forward, the federal government is still running huge deficits. That trend seems to be worsening year after year. Exponential debt growth results in exponential money supply growth as the currency gets debased because the debt has to get monetized. And that's a bullish tailwind for risk assets we price in the debasing fiat currency like the S&P 500 and fixed supply risk assets like Bitcoin. But as always, let me know what you expect. Thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.